Without this one document, sellers will not even look at your offer. In fact, not having a mortgage pre-approval can cost you up to $50,000 in lost opportunities. This video is designed to help first home buyers understand the importance of Mortgage Pre-Approval 2026. By the end of this video, you will learn what mortgage pre-approval is, how to get pre-approved, and the benefits of having a pre-approval in place. You will also learn how to avoid common mistakes and choose the right lender for your mortgage pre-approval. What is mortgage pre-approval? Mortgage pre-approval, also known as pre-approval, is a document issued by a lender stating that you are eligible for a certain amount of credit, usually in the form of a mortgage. This document is usually valid for 30 to 90 days and is based on your credit score, income, and debt-to-income ratio. For example, if you have a credit score of 700 and an income of $80,000 per year, you may be eligible for a mortgage pre-approval of $400,000. How to get pre-approved? To get pre-approved for a mortgage, you will need to provide the lender with certain documents, such as your pay stubs, bank statements, and tax returns. The lender will then review your credit report and calculate your debt-to-income ratio to determine how much you can afford to borrow. This process usually takes 1 to 3 days and can be done online or in person. For example, if you apply for pre-approval on Monday, you may receive your pre-approval letter by Wednesday. Benefits of mortgage pre-approval. Having a mortgage pre-approval 2026 can give you a competitive edge when bidding on a house. Sellers are more likely to consider your offer if you have a pre-approval in place, as it shows that you are serious about buying and have already begun the mortgage process. Additionally, having a pre-approval can help you negotiate a better price, as you will know exactly how much you can afford to pay. For example, if you are pre-approved for $400,000, you may be able to negotiate a price of $380,000. Common mistakes to avoid. One common mistake to avoid when getting pre-approved is not checking your credit report beforehand. If you have errors on your credit report, it can affect your credit score and reduce the amount you are eligible to borrow. For example, if you have a credit score of 650, you may be eligible for a mortgage pre-approval of $300,000. However, if you have errors on your credit report that lower your credit score to 600, you may only be eligible for a mortgage pre-approval of $250,000. Choosing the right lender. When choosing a lender for your mortgage pre-approval, it's essential to shop around and compare rates. You may be able to save up to 1% on your interest rate by choosing the right lender, which can save you up to $10,000 over the life of the loan. For example, if you choose a lender with an interest rate of 3.5%, you may save $5,000 per year in interest payments compared to a lender with an interest rate of 4.5%. Don't wait any longer to get pre-approved for a mortgage. Click the link in our description to get started with our recommended lender and take the first step towards owning your dream home. With their competitive rates and easy online application process, you can get pre-approved in as little as 1 day and start house hunting with confidence.